All right. Well, good morning, everyone. It's Joe Pochodyniak here with McNichol and Associates Asset Management. I'm joined today by Michael Baker. Michael is a principal and partner with ICM Asset Management, and we are in ICM's really interesting and really innovative Crescendo Music Royalty Fund. We thought that with Taylor Swift leaving the Greater Toronto area and the streets finally being reopened to Toronto's existing soul crushing traffic, it would be a good time to do a podcast on music royalties. And Michael, welcome. We were at your research lunch a couple of weeks back. Really, really interesting stuff. And I know we've talked with ICM before, but why don't you just go ahead and give us a little bit of background on yourself, the firm, and what you hope to achieve with this really great sounding music fund here.
Sure. Thanks for having me. So maybe to start, ICM as a firm has been around since 2003, and we manage a series of funds focused predominantly in real asset or private asset alternatives. And really our client base ranges from portfolio management firms, family offices, right up to full-scale institutional platform and everything in between. But like I said, the commonality between all of our different business lines is that they are real asset in nature, and we have no intent to invest capital through the public markets. So that's kind of led us to where our platform is today, where we've got a real estate business, a credit business, a small venture capital business, and then the topic of today's conversation, a very rapidly growing music royalty or music IP investment platform. So the premise of what we've done here is relatively simple, and this is a platform for us that's been super interesting to talk about. But when you look at this from a financial asset point of view, you have a ridiculously simple business model, and the entire business model is predicated on the fact that music has to be licensed. So the way that the music industry works right now is that if you're hearing titles, regardless of whether you're hearing it through a traditional music streaming service platform like a Spotify or an Apple or an Amazon, or you're hearing it through social media platforms, video games, connected fitness platforms, TV shows, movies, everything in between, if you're hearing music, whoever owns that underlying intellectual property is being paid a royalty for its use. So, like I said, our business model is incredibly simple. This has basically lended itself to the fact that all of these different industry components, whether they be artists, creators, vocal coaches, legal advisors, tour managers, and alike, all own what are called catalogs, which basically means a collection of underlying intellectual property. And our business model is, like I said, very simple. We effectively pay a multiple on the trailing cash flow to acquire these catalogs of music, and then we hold them forever.
Sorry, I was just there on mute. Yeah, I'm really interested in this space, Michael. Not for the least of reasons. Was last night I dove into REO Speedwagon a little bit. I think I'm dating myself, but the one thing you talked about, which I don't think a lot of our investors here at McNichol might appreciate, is just how big the video game side of music is. Grand Theft Auto 5, arguably the biggest video game ever, had a ton of great songs in it. And of course, Grand Theft Auto 6 coming out next fall supposedly should provide a lift not only to companies like Take-Two Interactive Software, the parent of Rockstar Games, but music in general. And no, I find this to be really an exciting area. But please continue.
Sure, yeah, and to your point, I mean, we kind of live in a world now where all of these different mediums act as music discovery sources. So, one interesting fact would be that TikTok is now the world's largest music discovery platform. So that doesn't necessarily mean that you derive all your revenue from TikTok, but we've seen examples of titles that go effectively hyperbolic as a result of it being included in some sort of a fad or a TikTok trend. And then people ultimately just revert back to music streaming platforms to then further digest the content. So all of these different kind of industry components do kind of filter its way into to driving engagement growth and user growth. But yeah, maybe just to continue the end result. I mean, at the end of the day, we're doing this for a reason, and we do it because we believe that the acquisition of these music catalogs provides a very interesting investment benefit to our clients. So again, like I said, we pay a multiple on the trailing cash flow. We tuck these acquisitions into a broader portfolio, and then we intend to hold them forever. And the end result is a distribution or yield stream and total return profile that has no correlation to other components of portfolio construction. And these are extremely long lasting assets. So they're very easy to kind of model and underwrite because not only are they in many cases 100+ year asset, but they also never require a dollar of capital expenditure to maintain the cash flows over the life of the asset. And I think that's maybe a really important piece to dig in a little bit deeper on, because if you think about other productive financial assets in our ecosystem, whether that be real estate, infrastructure, things like that, you have these ongoing capital cost requirements. So yes, those are great assets for generating yield, but in order to generate that yield, you've got all these different intermediary costs that you have to model and are sometimes unpredictable, right? So think about insurance costs, the costs of turning over tenants in buildings, the costs of replacing a roof on a periodic basis. Those are incremental capital costs that we don't have to factor in the music royalty platform, right? Because we effectively have an asset where your top line revenues equal your bottom line cash flow. So from a kind of a model perspective, it's a very simple financial asset to look at.
Right. Yeah, and I think that's an extremely important point. The two main ones that sort of leap off the page here off the slide, Michael, are the low correlation to equity markets, which we just love around here, but also the long lasting life cycle of these streams of royalties. So yeah, that's really important.
Yeah, and on that life of asset, that's actually set by that's an IP law. So the way that it works in music is that the owner of the underlying intellectual property related to any music is entitled to receive royalties for the life of the artist plus 70 years. So the way you should think about that is that you've got effectively a 70-year clock, so 70-year clock that starts the day that the last remaining band member passes away. So if you kind of use simple arithmetic and back that out, you'll see that the average life cycle of an underlying asset in our portfolio would be well in excess of 100 years. And maybe
yeah, and we just really it's interesting because we just put out our commentary to the investors, talking about in the first article the run up in crypto, the blockchain, and tokenization, and one of the things we pointed out was tokenization as a digital way to ensure the authenticity of various real legal assets. Have you ever encountered situations where the legal owner of the asset, meaning the song and the revenues it produces, has been called into question or maybe contested?
So back in the day, this was a problem. You had scenarios where bands were effectively using back of the napkin or envelope style record keeping, where they were saying, okay, this person was involved in writing the song, and this person was involved in the sound recording of the song, and it was a little bit messy. Today, it's not a problem. It's a highly sophisticated space, and from a governance perspective, you should think about the industry as a bit of an oligopoly. You've got Sony, Universal, and Warner that effectively have their tentacles involved in every aspect, from the the IP ownership right through to the administration, right through to the record label side. And so this is I think it's really important to point out that this entire ecosystem was set up so that artists and creators can be easily paid for their work. And it was certainly not set up so that ICM Asset Management has a simple business model to be able to put on a slide presentation deck, right? So we're effectively just adding a financial instrument bolted onto an existing platform that was set up and designed for ease, if that makes sense. And I think maybe while we're on that point, it would be important for your listeners to kind of understand the economics of how this business works. And we're going to obviously keep this extremely high level, so this would be kind of a dumbed down way to think about it. But the way that we generate revenue as a byproduct of owning these underlying assets is that revenue is generated at the top of the ecosystem. I think we actually might have a slide on that. Yeah. So again, this is, and I'll try to distill this down even more simple than what you're looking at here, but the revenue that's generated at the top of the ecosystem is generated either through subscription service revenue, ad supported revenue, sync licensing agreements, etc. And you should think about that as, in the simplest example, it's the $10 a month you pay for Apple Music, or it's the X ads that you're seeing on YouTube in order to watch content. So the revenue is generated at the top. And then the platforms themselves keep about 30% of the revenue, and about 70% gets flowed down through to the value chain, which includes IP rights owners. And there's these intermediary groups that sit in between those who generate the revenue and those who own the underlying intellectual property, called PROs, or performance rights organizations. So the big ones are ASCAP and SOCAN and BMI. And effectively, these are intermediaries that are there to collect and administer the revenues coming from all the different payee sources, because you can imagine that there's revenue being driven by dozens and dozens and dozens of platforms across millions and millions, if not billions, of streams. And then all of that data has to be aggregated. So our business model, again, not to reuse the term simple, but it really is simple in the sense that once we've gone out and sourced and acquired a deal and tucked it into the larger portfolio, we then just re-register that IP as us being the legal owner of it, and the money just kind of gets deposited into our bank account. And again, this is a simplified way to look at it.
Yeah, and it's interesting because one of the questions I had, and I don't know if we talked about it at the research lunch, is this sort of a developed Western world type of investment opportunity, or are you seeing it kind of dripping into the emerging markets? I know Boomplay had an issue in Nigeria where Sony pulled all of the tracks from Boomplay over non-payment of royalties, and I'm just wondering whether you have any comments on that issue specifically, or in general, kind of the breakdown between EM and the rest of the world.
Sure, and you are partially correct that this is a much more established business in developed markets, but that's changing very quickly. So if you were to look just a handful of years ago, and really what you're looking at here is a chart of kind of how the music revenue breakdowns have occurred over time, and you can most people can conceptualize this, that in the early 2000s through the 2010s, you had physical music sales, which would be LPs, records, tapes, etc., CDs, dominating the revenue mix. And then Spotify, of course, was launched out of the Scandinavian countries in the early 2010s, and we're very quickly trending to a point where streaming will be the only economic driver that matters. It will generate more and more of the pie, and the pie will continue to grow. So to answer your question, yes, historically the music streaming revenue has been quite, call it, North American and European dominated, but that's changing very quickly. And we have the benefit of the pricing power associated with these assets. So again, to revisit the fact that 70% of the revenues gets flowed down to the value chain, which includes IP rights holders. So they're one-to-one splits on if there's price increases, new markets unlocked. So if Spotify goes out and says, like they do on a periodic basis, that okay, now your subscription costs $1 extra per month, that incremental revenue increase flows proportionately down to the payments that we receive as the rights holders. If new emerging markets continues to be launched into, given the more established 5G and network capabilities that the globe is getting access to, Starlink, et cetera. Well, those are all incremental revenue sources. If new platforms get launched, think TikTok, that start to generate revenue and have to license music, well, that's just incremental revenue. So again, we're not really in the game of other people's business development efforts. We're kind of the beneficiaries of the kind of the rising tide lifts all boats, if that makes sense.
Yeah, no, it absolutely that absolutely makes sense, Michael. And again, like what I love about the strategy is that there's a long runway. Again, it's uncorrelated, and this is really kind of an innovative alternative asset class. Sometimes with real estate, as you package it into a REIT and it's kind of mainstream, and you package it into a limited partnership and suddenly it's alternative. This really is an underlying sort of investment vehicle that I think really sings to our investors here.
Yeah, and I think that the less complex nature of the investment profile makes a lot of sense, right? I mean, there are a lot of alternative asset strategies out there, and
Sure.
what I find is that a lot of them have a business plan that has to be executed in order to earn a return, right? So they're saying, okay, we are going to deploy capital into company XYZ, or venture capital pool ABC, or development real estate asset XYZ. And the business plan is that we will earn a return on the deployed capital. Here, it's highly simple, right? Like, we are buying a existing asset with an existing cash flow stream that starts generating cash flow the day after we purchase it. So there are much less moving parts, and of course that means that your potential return band is going to be narrowed, right? When you think about paying, well, in aggregate, we've acquired our portfolio for about 11 times trailing cash flow. And as a byproduct of that, it's not a strategy that would you could conceivably see doing a 20% year, just because our returns will be dictated by one thing and one thing only, and that's the cash flows from the underlying asset.
Amazing, great stuff. Yeah, I love looking at these growing charts, and maybe just on some of the other. Sorry, I got distracted there, but actually, you know what? Please continue, Michael, because it's just such an interesting space. I really enjoy listening to it.
Sure. So maybe just talking quickly on the portfolio, we've done a few dozen acquisitions across effectively every genre and every age category that you could think of in music. That's by design. So right now we've got hundreds of artists across thousands and thousands of pieces of underlying intellectual property. But the only commonality between all of the acquisitions that we've done is that they look reasonably similar from an economics perspective. So we want to own artists that are reasonably iconic. Given that these are 100+ year assets, we want to acquire assets that we believe will be in use in 50, 100 years. So we don't really want to acquire anything that's quote unquote flavor of the day or not iconic. And we are typically deploying capital at similar trailing multiples. And we like to buy things when they're slightly older. So if I go back a couple slides here, you'll see that, and again, this is kind of an illustrative look at it, but this green line would be illustrative of a deal that we would be interested in doing. And the red line would be illustrative of a deal that we would not be interested in doing. So from the green, yeah, go ahead.
No, I was going to say that's right. I mean, you're looking for ultimately songs that really can produce revenues, right? No one's going to pay me to sing, that's for sure.
That's right, and like I said, it has to be reasonably iconic, and there could be people out there that have success with doing, call it a more venture capital type approach to investing into music IP, right? Which is more akin to like going out and finding an artist that they believe might be the next latest and greatest and deploying capital, call it in year zero. Our business model is far more focused on finding cash flow streams that are already established and just paying an appropriate multiple to acquire them. So typically when you see an acquisition from us, you'll see this term called dollar age. And dollar age just really relates to how long the IP has been in existence for. And if we flip forward to our kind of current portfolio breakdown, you can see that, on this right-hand chart, you've got something that says songs by age. That's how old the titles are. And you can see that we effectively own nothing that's new. And as I mentioned, that's by design.
Okay, very good. So there's
Diversification by
definitely
genre.
there's definitely I notice on this chart, and I think I've seen this one before, is that there is a sort of a heavy weighting towards um, how shall I say this? Maybe a younger demographic in terms of pop. But I mean, maybe that's not even true because, a lot of rock and roll songs are, they cater to a broad range of listeners.
Yeah, and you know what, Joe, like the pop and the rock categories are a bit of catch-all categories, if you will. So, there's, for example, like hip hop is hip hop. Like people define that as hip hop, right? Country is country. People define that as country. Pop and rock have a much wider array of types of music. So if I look at, deals that we've done in rock, for example, right? We've purchased Kevin Churko's heavy metal catalog, which is comprised of Five Finger Death Punch and Disturbed. And we've purchased the Lumineers catalog as well. So, I mean, in my head, those are two highly different genres that you would both quote unquote classify as rock. So those two main kind of bucket categories are a bit of a catch-all, if that makes sense.
Right.
Anything else you want to chat on?
No, I think this was a really great overview, and I really want to thank you for doing this, Michael. It's always a pleasure to talk about something a little bit more exciting, a little bit more lively, but also something that our investors can make money off of, which is sort of the whole point of investing. And I really like the way you kind of touched upon the runway, the low costing, the ability to, like, again, you make an investment and you're literally clipping royalties, as opposed to making an investment, a cap call goes out, or you make a commitment, you J curve yourself deep into the red, and then you have to wait and wait and wait and wait. This is a more immediate strategy, and I do like the portfolio approach. So thank you very much. I guess we're going to wrap up at this point, but we'd be delighted to have you back again in 25 for an update, maybe this time next year. And on behalf of Ken and myself, thank you for your time, and we really appreciate our partnership with ICM.
You're most welcome. Thanks for having me, and definitely in for doing it again in 2025.
Great.
Okay. Happy holidays.
Happy holidays.